Welcome back to the Dividend Diplomat's YouTube channel, guys. You've got Bert and Lanny, the DD, and we are back with three stocks on my watch list based on what just closed on the final day of August 31st. Are these three stocks to buy right now? Let's find out.
Smash that subscribe button. Give this video a thumbs up. Holler at your boys. Lanny's bringing his dividend stock watch list. You know what? Let's do this. Let's get to financial freedom together. Let's freaking go.
Guys, three stocks right now. When the market is up, when the market is down, the dividend diplomats try our damnedest to always be buying A, B, B. So what did the market do the last 30 days? First off, guys, the market finished down about what, 1.5% down, 69 basis points for the month. They
Ooh,
still hung though above 4,500, which is frustrating. They finished off the last 5 trading days at a plus almost 3%, plus 118 points. So at one point it was actually in the 43s. So was really hoping we would get a little bit more red to finish the month off. Bert's frustrated. I'm frustrated because when the market goes up, it makes those opportunities just a little bit harder. It makes it harder to find those stocks to buy. I mean, Bert, how have you been feeling over the last few days?
just been nibbling here, there, bobbing and weaving our way through the market, just like nothing really jumping there, but grabbing some shares, keeping that income growing. But you're absolutely right. And even though it's harder, though, it's not impossible. And that's why we're always looking at our dividend diplomats, dividend stock screener to help us find stocks that are undervalued when the market's high or when the market's low. And what are those three metrics of our screener, Lanny?
We look at that price to earnings ratio less than the S&P 500, which really shows, hey, is the stock undervalued versus the market as a whole? Share price divided by future earnings. Then we look at that dividend payout ratio less than 60%. Can this company sustain to pay the dividend? 60% is used because the next metric, that third metric, dividend growth. Dividend growth because you're a passive income investor trying to buy dividend stocks to add that extra income source. So you want to make sure that there's enough room in that payout ratio to continue to grow the dividend. Then we put a little cherry, a little whipped cream, little ballop on top of that dividend yield. The final metric, we'll look at the dividend over the share price because that's how much that stock is going to pay you to own the stock in your portfolio. So guys, we've been investing here. Bird's been investing over 10 years. I've been investing over 14 years. And, there are times when we get frustrated. And this is definitely up there with the top 5, maybe top 10 frustrating time periods because this market should not be where it's at, but it is. And, but we still found three stocks, right, Bert?
Yep, that's right. Let's see it, Lanny. Let's talk through dividend stock
The
numero
big reveal.
right now. I'll do the drum roll.
Well, let's go hop in a Honda Accord that's got 160,000 miles. Let's head up across the border up north into Canada. We're looking at one of the big six banks, the one that's in my portfolio. And Bert, I'm pretty sure it's in your portfolio.
It
And
is.
actually, guys, subscribe to this channel if you haven't. We're trying to get to not just the 18,000 subscriber mark, but we're trying to finish the year off at 20,000. So it'll help us get there. So, guys, one of the big six banks, let's get back to it, is Canadian Imperial. Ticker symbol is CM. And man, this stock is down 15% over the last 52 weeks. And they're now trading back below $40 a share. I know Canada's got their own issues going on right now with interest rates and real estate, but they are back on the radar.
They are. And this is that $40 per share mark seems to be the threshold here for Canadian Imperial. They always seem a little juicy, and it's always time to possibly nibble on one. Let's see how they look in that price to earnings ratio. That share price is 39.61. EPS is 5.13. PE ratio is less than 8. It is 7.73x.
Not too bad. Not too bad for the banks. That's kind of where you see like your Citigroup, your Bank of America, maybe some of your other bigs in the US. So they're right there playing with them. Now, with the dividend payout ratio, they pay about a 66 cents. Somebody can do the conversion to confirm that per share per quarter. So you take that over that 513, they're almost right at 50%. They're at 51.5% rounded. fairly safe, a little bit higher for a bank, but still fairly safe to continue to pay the dividend right now.
Yep, they've increased that dividend for 12 years, so they're halfway to becoming an aristocrat. That 5-year dividend growth rate is 5.3%. And what's that yield, Landy?
Everybody loves the banks for their yields, their consistent growth. Canadian Imperial used to grow at about 2 times a year. COVID slowed that down a little bit. They were trying to come back with it. And then, this hellacious banking crisis that we have going on has also made things a little bit more volatile. But yeah, that yield is 6.66%. Oh boy, 666. Don't
Iron
buy it at the
Maiden
current
fans
stock
out there.
price.
Yeah, Iron Maiden fans out there. Up the irons, baby. Let's go. Get the number of the beast.
Oh
Uh,
man. So we're
yeah.
going to
I
summarize the
haven't
metrics.
made one of those references on this channel in a while. Good old Iron Maiden. All
It's
right.
been 2 weeks. No, I'm kidding.
Yeah, no. So PE ratio 7.72, payout 51.46%. 5-year dividend growth rate 5.3%. Here's increasing that dividend 12 with a yield of 6.66%. Let's hear what dividend stock number 2 is, Lanny.
All right, guys, we're going into the pantry. We're actually going out of banking or taking some money out of the bank. And we're going to go into the consumer goods arena because food is consumed. People still eat, and companies such as Hormel, ticker symbol HRL, continue to evolve themselves, evaluate their brands, try to get more healthy in there. Because we all know about their pepperoni, Hormel Pep. You gotta love it. They've got their Spam. They've got their, more fatty, unhealthy products. But they have Justin's peanut butter. They have Natural Choice. They have a bunch of other, you know, normal, common goods that you
Yeah.
see in your cupboard. Skippy
Yeah.
peanut butter.
Yeah. So I mean, great brands. These are the ones that people are always going to be buying no matter what happens. Just like we're always buying stock, people are always buying Hormel ABH. So let's talk here. Let's run it through there. Their price was 38.59, earnings per share 173, PE ratio 22.31. Not the cheapest stock, but a lot of these consumer staples like Hormel are never going to be the cheapest stock out there. We're not looking for the cheapest. We're looking to make sure it's undervalued compared to the market, and that it is.
Yep, and it is below the S&P 500 for sure. So let's get into the payout ratio, guys. They pay 27.5 cents per share per quarter, $1.10 per year. Take that $1.10, divide it by $1.73, and turn that bitch sideways and stick it. No, I'm kidding. But that comes out to a 64% dividend payout ratio for Hormel, a little bit higher than that ceiling that we'd like to see, which means to me what this next metric may look like going forward.
They've increased that dividend for 56 years, and their 5-year dividend growth rate is 8.20%. So to your point, the higher the payout ratio, you're going to need substantial earnings growth to maintain a large dividend growth rate. So if earnings grow 8%, it's going to be much easier for a Hormel to continue that 8% dividend growth rate. But we'll see if that's possible in this current environment. It's very difficult.
And that last dividend increase was 5.8%. So you're already seeing a little bit of a slowdown in the dividend growth comparatively to that 5-year average. But Bert, what's that yield look like, and how does it compare to that 5-year average yield?
Yields 2.85%. Their 5-year average yield is 2.12%, a big sign of undervaluation. And then on top of it, they're down 15.65% year to date, down 17.86% over the last 52 weeks. Hormel, everybody.
What to do? I own a bunch of shares. Gosh, I would love to get them at 3%. I would love to get them at 3.
Put the limit order in. I think that's the answer. Put your limit orders in for Hormel.
Lock up the cash. Guys, what are you doing? Do you guys want Hormel stock at 3% yield? 3%, Bert, what is that? Let's divide this right here. We need a 3% yield, or 36.67. So we need a $2 decline in the share price. Let's go.
That can happen. Let's move to dividend stock number 3, because didn't we just talk about this company here, Lanny?
Yeah, if you guys didn't catch Saturday's episode, come on, click the link, go check out the content. Oh, by the way, like this video, subscribe, because I know you're still here with us, but I want you to rock with us on every single video. We are talking back about the king of kings, the Triple H of the dividend stocks, guys. We are talking Johnson & Johnson, ticker symbols J&J. Yes, they're on my dividend stock watch list, and hopefully
Yeah.
everybody here will say makes sense.
Let's
Bert,
see.
hit them with the music.
Yeah, 161.68 share price, $10.03 forward analyst EPS. P/E ratio is 16.12. It's right in Johnson Johnson's good old reliable range of 16 to 18x.
Always there. I swear to you, it is hard to see J&J not be in that 16 to 18 realm. I feel like they've been there for years. Been, almost a decade since I've been investing over here.
Yeah.
Um,
So let's talk about that payout ratio. Let's see if how that's holding up. After in their last split up, they basically said we're maintaining the same dividend. So the annual dividend staying the same, even though they shipped off a bunch of shares and they took that revenue from Kenvue is gone. Their annual dividend is $4.76. That's a 47.5% payout ratio.
Still solid. We use $10.03 as Bert indicated as that expected earnings per share, which I think was on the lower end now of management's guidance.
It was between $10 and $10.10.
Yeah, so there we have it, guys. Increasing their dividend a couple years,
Mm-hmm.
60 straight years of increasing their dividend at an average rate of 5.92%, with the payout ratio below 50% and prospects to grow at 8 to 9%. I think they're going to be able to do this.
Yeah, and their yield is very close to that 3% mark. It's at 2.94%. So it's almost there. It is almost there.
Got
That's a big milestone for Johnson and Johnson when it hits that 3%.
158. Keep your eyes on
Yeah.
158 and change. Let's see. Are you guys a buyer at 3%, similar to Hormel? Let us know in the comments.
Yeah, so and it's above their 5-year average yield of 2.67%. So not as drastic of a spread there as Hormel, but just as strong, a still solid differential there for Johnson and Johnson.
Guys, so that's a 16 PE, a 47% payout ratio, 60 years of growing dividends at over 5.9%, with the yield that's now approaching 3% for J&J. We're going to flash all three stocks right now on the watch list on the screen in case you're viewing, the channel right now instead of just listening on that lovely car drive here on a Sunday morning, or hey, maybe you're listening to us on your jog right now.
Yeah. So Lanny, rank them 1, 2, 3. Canadian Imperial, Hormel, Johnson & Johnson. Go. Let it rip.
J&J, because I feel like they can get to 3%. I'll be a buyer at the 158. Canadian Imperial. I'm so stubborn. I want them at 39.00, and I think they're very close there. Then Hormel, if they crack below 37, I'm flying in with the Hogan leg drop, snap it into my Hormel. I don't know. Do they own Slim Jim? I think they actually do, don't they?
Actually, don't know off the top of my head. For the sake of the video, let's say they do, because it's much more fun.
I'm going to snap into the Slim Jim of Hormel, and I'm going to gobble up a few shares. Probably get 3 shares for 100, even. And yeah, so J&J, Canadian Imperial, Hormel. If you guys were to rank them, let us know in the comments out of these three. Bert, back to you. How would you rank these 3 stocks?
I would go Johnson & Johnson, Canadian Imperial, and Hormel. Same order. Same order.
Whoa, it's almost like we're 2 dividend diplomats.
That's right. So everybody, let us know how you'd rank them. If you haven't already, subscribe to the channel. Make sure you give this video a good old-fashioned thumbs up. And Lanny, what else do we have to tell all the viewers out there?
Well, let me tell you something, brother. You're either with us or you're against us, Jack. That was Bert the Hurt and Lanny from the DD. Over and out.